Everyone. My name is Bill Giffin with HTTC Wealth Partners. We appreciate everybody taking the time today to spend some time with Stephanie and myself. Stephanie Link is the Chief Investment Strategist at Hightower Advisors. Prior to joining Hightower, Stephanie was a senior Managing Director and Head of Global Equities Research at Nuveen. She also served as Chief Investment Officer at The Street, co-portfolio manager of Jim Cramer's Charitable Trust, and also was Managing Director of Institutional Sales and Director of Research at Prudential Equity Group. Stephanie also manages portfolios for Hightower and our clients. And also you may have seen Stephanie on CNBC. She's a key contributor there on several shows, including Halftime Report, Closing Bell, and Squawk Box. So Stephanie, thanks so much for joining us today. We really appreciate your time.
Thanks, Bill. I think
it was about 6 months ago, Stephanie. It feels like 6 days that you were on the same conversation. So we appreciate you taking the time. And a lot's happened since then, and a lot's happened even the last couple of weeks. And so it'd be great to even maybe just start with a reflection on 2023 and what your thoughts are on what we saw.
Sure. So 2023 was quite a year, a lot of surprises. I think this time last year, it was pretty much consensus that by now we would be in a recession. And in fact, quite the opposite happened. We grew and expanded growth throughout the year. We grew the first quarter of last year 2%, in the second quarter 2.1%, in the third quarter a whopping 4.9% growth, and we're on track to do about 2.5% in the fourth quarter. We're actually on track to do about 2.4% for this quarter that we're currently in as well. I guess the point being is there's a heck of a lot more growth than people thought. And I look back and I think one of the main reasons is because there was so much liquidity that was put into the economy back in 2020 when we closed the country. We had an unprecedented amount of fiscal policies put in place, monetary policies put in place, very loose, easy conditions for the economy, hopefully to snap back. And we did snap back as a country, for sure, much quicker than people thought. And I always like to give this stat just for context, but in the height of all this money that was put into the economy, that was about 60% of US GDP. By contrast, back in 2008, when we had the great financial crisis, and we had some really big banks that failed, and they did put in a lot of money into the economy, it was the equivalent of about 5% of US GDP. So that just gives you that magnitude of what we did over the last several years. And why I mention it is because it takes a long time, Bill, you know this just as well as I do. It takes a long time to get all that money into the system in a big way. And it could take as much as 2 to 3 years. And so we have seen that that work its way through to the economy in terms of growth, in terms of inflation, and I'm sure we'll talk a little bit about that. Yeah. And then late last year, we passed $2 trillion of additional stimulus and infrastructure. And that hasn't even entered into the economy. And so all this money is kind of swashing around, and it's doing good things in terms of the growth and the support of earnings, which really is kind of the lifeblood of what stocks do, right? Earnings go up, stocks go up, earnings go down, stocks go down. And so the economy feeds into earnings, and that's why we had such a powerful year last year of up 26%. I would say the other surprise was that it was so narrow. That 7%, that's the Magnificent Seven, the Microsofts, Amazons, Googles, Metas, etc. The Magnificent Seven accounted for just about 85% of the returns, overall returns, which is crazy how narrow the market really was. And it's interesting, the top 10 growth stocks, including the Magnificent Seven, are now 35% of the S&P 500 weighting. It's a huge, huge, huge weighting. So I thought that last year was kind of interesting. We did start to see in October of last year, we did start to see a little bit of broadening out. The S&P 500, the equal weighted index was actually outperformed the market cap weighted by 200 basis points. That's just a fancy way of saying other sectors started to participate and other stocks started to participate. So the thought was, why that occurred is they got very oversold, very cheap, but B, if the Fed does start to ease, then you can see kind of a reflation and a better growth environment in 2024. We shall see. I think there's a lot we can chat about in terms of the Fed and inflation and that sort of thing. But I do think last year was certainly one that I think surprised a lot of us.
Yeah, and maybe that's where we start. Just a quick comment on 2023, right? I mean, the conversation was all around the Fed, all around a predicted recession. How deep? How long? What does that look like? And to Stephanie's credit, she was not one that was anticipating a deep, long recession. Really more a softer approach to what we were expecting with the economy. So, well done there, Stephanie. Thank you for those comments about 6 months ago. But yeah, maybe we start there as we look at 2024 and some of the comments around the Fed, rates and inflation, right? We're looking at some expectations from a standpoint of maybe some rate cuts as we go into 2024, and then just even where you see inflation as we go throughout the year.
Sure. So we hear a lot about from the Fed and the governors. They like to chat a lot and talk to the TV commentators. And last week we heard from the Fed President Waller, and I just think it was so interesting what he said. He said about the economy, he said, well, it's almost as good as it gets in the economy in terms of we are soft landing. We're slowing down from the torrid rate of growth in the third quarter, but we're not slowing so materially that we go into a recession. And as we slow, we are seeing inflation come down. Remember, last year, about a year and a half ago, the CPI inflation reading was 9.1%. You're now today at about 3.4%. And that a lot of it is because we really have fixed the supply chain. We have fixed the inventory glut. We have had lower commodity pressures like gasoline prices. And so we are seeing inflation come down. At the same time, growth remains pretty good at 2.5%. Mm-hmm. That's a great combination. And that's one of the reasons why we are talking about the Fed kind of taking their foot off the pedal, off the gas in terms of raising interest rates. And that's why we're starting to talk about the Fed easing and cutting. Now, I do not think that the Fed is going to cut 6 times, and that's actually what the bond market is pricing in. That's what a lot of people are thinking. I think that the Fed, they don't have to, because there is so much momentum in the economy, number one. Number two, inflation still is at that 3.4% level. We know the Fed wants to get that number down to about 2%. So we have a little ways to go. Where are we seeing inflation? We're still seeing inflation in wages, and we're still seeing inflation in rents. I do think you're going to start to see a rollover in rent prices. Just looking at some of the multi-family housing data that I see. And so I think we will make progress. I think we will get down closer to 2%. And that will be enough for the Fed to then all of a sudden, they can do their thing. But I just think 6 times is a bit aggressive, and they just don't have to. And what we're in is we're kind of in this sweet spot. That's why I quoted Fed President Waller. We are about as good as it's going to get in terms of the economy. That doesn't mean that we can't stay as good as it's going to get. Right. Right now, we're running at about 2.4%. And a lot of that has to do with a very strong consumer. The consumer is supported by very, very strong job numbers, wage growth, and retail spending. And we also have a little bit of a manufacturing renaissance as well, in that we have just put money into this infrastructure bill. And we are starting to see and hear companies doing more onshoring and reshoring. And that's a big, big theme, Bill, for me. I think it's a 10-year theme, but that's actually also adding a lot of momentum to the economy.
That's interesting. And it's interesting comments on the consumer, obviously, that's carried the weight for the economy for a long time.
Yeah.
That's interesting. And I've got so many questions, there's so much going on, but maybe we dive in a little bit into the specific markets. And we sit here today with some record highs and things of that nature. And we kind of move into earnings season right now, and expectations there. And as you said, earnings drive price. How do you see this season falling out as we dive into the earnings season?
Yeah, so I always look forward to these times of years, because the 4 times that we hear from companies, and they have so much to say, and their body language is terrific. So on the positive and on the negative, we learn just so much. But I do think we are going to see a little bit better earnings. And the reason why is because, as I mentioned earlier, the economy is hanging in there. It's doing better than hanging in there. And I think in a 2% GDP world, that gets you something like 5, 6, 7% in top line in revenue growth, usually, typically, for the S&P 500 as a whole. Obviously, they're going to be higher and lower, but 5, 6, 7% kind of thing. And I think with inflation coming down and companies still having pricing power, I think you're going to see better margins. And so when you have a little bit, some solid mid-single digit revenues, you've got pretty good margins, you have a nice positive operating leverage. I think you're going to do something like 8 to 10% in earnings growth this year. Again, it all really does depend on the economy, and the economy is just hanging in. So that's actually a good thing.
Yeah.
I think the better value versus the Mag 7 are those 493 other stocks that did not keep up. That's not to say not to own technology or the Mag 7. You can own them. You just don't want to have 35% of your portfolio in any kind of an asset class, to be honest. So you certainly want to have some exposure to technology. I think there are better values elsewhere within tech, if we can talk about it if you like. But I also think if the economy can stay solid, you will see some of the more cyclical companies do better. Industrials, I mentioned the onshoring, reshoring theme. Anything tied to aviation, I know Boeing is having its problems. They will get through it, but that is a very positive and powerful theme. I think housing is also a really interesting theme for 2024. And that is mainly because interest rates are coming down and we are 5 million homes short in this country of homes. The home builders have underproduced for the last 13 years, and we have 5 million millennials that are just about to enter into buying homes. So I like industrials, I like housing, I like the consumer, as I mentioned before. I think discretionary will hang in.
Yep.
I think energy and financials are down and out and pretty cheap, and I like healthcare. So I like a lot of stuff away from tech. And I think that's what I am expecting, a more broad rally this year.
And so, as you mentioned, kind of diving a little deeper on the financials, if you look at the banks and you talk about rates, how do you see that in 2024?
Yeah, so the banks, the banks are an interesting group. I mean, the big six are the JP Morgan, Citigroup, Wells Fargo, those kinds of names. The big six are in a really an interesting spot because the government has made them have so much excess capital, and they have since the great financial crisis. And it's a really good thing, by the way, because we would not have gotten through Silicon Valley Bank and the closure of that bank last year and some others if we didn't have such fortress balance sheets at the big six. And so I think they are actually taking market share. Will they do well in this current environment with the yield curve where it is? I think it's a bit of a struggle. But if you think we're not going into a recession, the yield curve should actually should stop inverting and actually steepen, and that's very good for net interest income and net interest margin. And I also think you want to have exposure to capital markets because we are seeing and hearing that M&A is coming back, IPOs are coming back, and just overall activity, very, very cheap sector as well.
That's it. And then also kind of going across the pond internationally. What's your thoughts there?
I think there's always opportunity to have exposure internationally.
Yeah.
I always look and say, okay, so our market, we're at about 20 times forward estimates. We're not cheap. And by the way, excluding Mag 7, you're at about 17 times, so it's a little bit more reasonable. But when I look at Europe, for example, it's at 13 times. It's always at 13 times, and it's because they don't have the wherewithal and the ability to cut costs, restructure, and lay off people like we can. I know that sounds horrible, but that's what we do when we have to, when the demand is not there. They have so much regulation in Europe, and so the operating leverage is not nearly what you would think. That being said, I think you do want to have some exposure, particularly the luxury consumer, which the stocks themselves have been terrible, but the consumer over there in Europe is very strong. I think Japan is certainly benefiting from the exit from all the companies leaving China and supply chains, and they're benefiting, and that market's at new highs. And I think China also, I think there's an opportunity because they do have so much firepower that they can actually reflate their economy at some point. I don't like China as a whole. I do like the Chinese consumer after being pent up in with COVID over the last several years. They had much more of a longer duration of COVID. So I think that that's an area. That all being said, Bill, I like US companies that have exposure to these regions. I don't necessarily want to own the pure plays international companies only because I think the S&P 500 is 60% of their revenues are tied outside the United States. And so you can find and have exposure if you want it, and you get better transparency.
Yep. And I guess just as I'm listening to, and for our clients that are on the call today, and you mentioned a little bit earlier around diversification, and you really just talked about a bunch of different from, on the domestic equity side, growth and value companies, bonds, international exposure. You mentioned real estate. And so, just as I listen to you, Stephanie, just kind of, reconfirm with our clients as you talk to your advisors to continue along that diversification track and review your financial plans, and then, make decisions alongside your advisors as you move forward. So I think that helps us,
yeah.
Stephanie.
I think that is spot on, Bill, and that's what you do the best, right? You are the holistic wealth manager, and you know your clients and what the asset allocation should be based on their risk profile and what their age and all that. I can just say that, and I'm sure you've seen it. For the last 10 years, when we had zero interest rates, there was no alternative. It was only equities. It was, if you wanted income, it was dividend growers, dividend payers, that sort of thing. But there was really no alternative. And that really changed last year. And I'm sure you've seen it with your clients, and that the 60-40 asset allocation discussion probably started coming up more and more because guess what? Their fixed income, you could actually earn some money for the first time. I mean, heck, you can make some money in cash, 5% in cash, and call it a day. So I think that whether it's 60-40, 70-30, 80-20, that's totally you and your team and what you do so well. But I would just say that there was competition for equities last year. And I think that that's going to continue this year. But if rates do come down, maybe less so than last year.
Yeah, and interesting too, also from a standpoint of maybe a broadening out of Magnificent Seven, as you said earlier. So that even reinstates it. So thanks on that. And then so now digging into a few other things that have evolved really since we last spoke is geopolitical issues, right? Yeah. So as we look at when we were on the call last time, it was just Ukraine and Russia. Now you throw everything that's going on in the Middle East right now with Israel and now Iran and others. As you've seen this and throughout your history, right, we've obviously had wars and issues geopolitically. How does that affect the market in your mind? And how do you view that as we sit here and read that every day and see it?
Yeah, and it's really scary, and it's really sad, and it weighs on all of us, all that is going on. And it is a big unknown. It is an absolute big unknown. And what I would say is you kind of have, as an investor only, you kind of have to tune it out. Yeah. Because first, believe it or not, wars usually add to growth, unfortunately, because you're spending so much on defense and that sort of thing. Mm-hmm. But that being said, wars are terrible. It's an unknown. You can wake up and certainly we get some terrible headlines, and that's just something that I think we have to deal with. That's why I try to ignore, because I try to just focus on what I can control, which are fundamentals of companies and listening to what they have to say. But there's no question it is a big worry point. You have heard me say this, Bill, many times. The market always climbs a wall of worry. It always worries about something. I worry when we don't worry, because that means we're complacent. And so it is an unknown. There are a couple of other unknowns out there as well. Life is not perfect by any means, but that's why I say kind of keep your head focused. And you've also heard me say this: just turn the TV off if it gets too much, if it gets too intense.
Except during your program, Stephanie.
I know. And I want you to watch me, but I understand. Right. I want you to be able to sleep at night too.
and to dive into another unknown as we go into 2024 and it being an election year, right? Yeah. And that's another question, right? We always think about how's the election affect the markets, whoever's in office, Republican, Democrat, however that looks. What's your thought on that as we think about, the election coming in this year, the uncertainty of that, and what that can bring in regards to volatility of the markets at all?
Certainly. So usually the last year of an incumbent is usually positive for the market. I don't know if it's another 24%, Bill, and I really don't think it will be. That's a big number last year. But I do think it usually is a pretty good year for equities. Usually it's because the incumbent can kind of pull some strings, do something in terms of helping the economy some way or another. But they've already pulled a lot of strings. There's going to be a lot of momentum, as I mentioned, just from that infrastructure bill that was passed last year. So usually markets are okay in a year of when you have a presidential election. It's really more important what happens to Congress. That's
Yeah.
what's going to move the market. And I'm not even sure it would move the market much higher or much lower. It would be sectors that get, you would see kind of a rotation into different sectors depending on who the president is, but also what Congress is. I mean, you know that the market loves a split Congress, no matter who wins in president, because nothing gets done. And the markets like when nothing gets done because we don't have to worry. It's one less thing to worry about. So keep an eye on the movement in Congress, and we shall see. But I try to keep again focused on just fundamentals because these are things we can't control.
Yep. Yeah. No. Well said. And as kind of diving a little deeper on Congress and politics and things of that nature and spending, what's your view from a standpoint of the debt in the U.S., right? Those are questions we get a lot from clients as they hear it and they read it. How do you view that?
Well, again, I mean, it's another worry point. So there's plenty of stuff to check it on off. I unfortunately, and I'm sure you're not going to like to hear this, and nor will your clients, but I think we're going to continue to kick this down the road, kick the can. And unfortunately, I think it's going to be our kids that are going to have to deal with it. It's the next generation or the generation thereafter that's going to have to deal with it. But we barely get a continuing resolution to get resolved, let alone fixing debt and the deficits and that sort of thing. I'm not sure it's going to get resolved from either party that wants to be president, to be honest with you. Both Trump and Biden liked to spend. It's just in different places and in different areas and in different ways. So I don't think that we're going to be resolving it anytime soon. And I think Janet Yellen, her biggest problem is to fund this debt. And with interest rates where they are and the Fed doing what they're doing, it's certainly not helping her cause by any means. So of course, she's rooting for lower interest rates as well. I'm not sure that Powell is going to listen to her. In fact, I'm pretty sure he won't. They are an independent entity, but it's something that we have to live with, and it's a shame. It doesn't feel good, but I don't think we are not going to be dealing with it anytime soon, unfortunately.
Yeah, I think you're right. And, really, as you think about, our children and future, it kind of takes me to something that affected the market significantly this year also was AI.
Yes.
And kind of what's your view on that? Even just, 2024, but just kind of the outlook moving forward on, you saw it affect the Magnificent Seven, right? With some of those names in there. What's your view there?
It's well, if you read from all that I read, and we're all trying to become experts at AI, but from what I read, it could be a $2 trillion total addressable market by 2035. That's according to McKinsey. It could be less than that. It could be more than that. The point being is you're at very early stages. It is real. It's not a 2000 boom kind of bust situation. The results are spectacular when used properly. So right now, what we're doing is we're trying to figure out the infrastructure part. How do we build it? How do the technology companies run it? So we're building the systems, and we're trying to figure that whole thing out. That's the NVIDIAs of the world. That's the Broadcoms of the world. And if you listen to them, the growth has been spectacular for both companies and a lot of companies that are trying and in part of this whole theme. I think the interesting part gets in a couple of years when it gets more advanced, because remember, AI really is only as good as the inputs that you put into the system. So the more inputs you're putting in, the better it gets, the more accurate it gets, and that sort of thing. But I think what's going to be interesting is when you have industrial companies that are using AI, auto companies that are using AI, retailers that are using AI, I mean, that will be something that will be much, much more powerful, I think, and much more broad. Right now, it's really focused mainly on the technology companies, the giants, because they have the wherewithal and they know how, what they're doing. But I want to just mention there was this on CNBC, there was the CEO of IBM, and he was on talking about AI. And I just like to listen to CEOs. So this is not an endorsement of IBM. This is simply, I'm listening to him because he made a lot of sense to me and he kept it really simple. But he said that their company had a client that gave IBM data to analyze. That's what one of the things that IBM does. They take data, they analyze it, and then they come up with a solution for their clients. And he said, when AI had such a big impact, a profound impact, they had a 20 person team analyze data, and it took them 2 weeks to get back to their client after they analyzed the information and give them a recommendation. He said when they tried this whole exercise using AI instead, took 2 days. 2 days. That's enormous productivity. And what his point was, they're saving money, they're more productive, they can use the excess money that they're saving and put it into top line revenue growth or M&A. And he said it's really this flywheel that is just so incredible. And I just thought, well, that makes a lot of sense. And it's very interesting. It's a little scary too, because you don't want to see AI displace people. I don't think it's going to displace a lot of people. I think it might in some industries, but people always want perspective. They always want the Bill Giffins of the world to help them in terms of just keeping people calm, giving good advice.
Thank you. Last kind of comment, because we are at the bottom of the hour and I want to be cognizant of your time. Sure. Stephanie, again, we go into 2024. We just spoke about a lot of different topics. Kind of in your mind, kind of last comments on where to stay focused on, what to think about 2024 as based on all your great comments.
Well, and it's really your great questions on the worry part of things, right? Just try to stay focused. Let you do your job. Let me do my job, and we work together as a team, which I think has been so much fun. Because you're an expert at what you do, and I'm an expert at what I do, and to try to dissect the day to day and the minutia is very difficult to do. But as you know, we talked about diversification. I am all about that. I think that there are certainly a lot of really good opportunities, again, with that 493 stocks that didn't outperform as much as the Magnificent Seven. And I think we are going to see a broadening out. I want to own a barbell. I want to own tech, certainly, but I want to own those other sectors that I mentioned as well. Good quality blue chip companies, number one, number two in their industries, good balance sheets, good dividend growth, good CapEx building, all that kind of thing. And sometimes those companies go on sale and we try to buy low and sell high. I think most people think they do, but they don't, because it's hard to do. But if you can find some good quality companies out there that are down for whatever reason, I think you can have great opportunities.
Thank you. And just, you mentioned earlier also the opportunity to spend some time with the CEO of IBM. Just for the group that's listening today, Stephanie has the opportunity to speak to many CEOs as she looks at managing her portfolio. And she's been a great resource to our group, to our team, to our clients as we think about investments and we position them appropriately moving forward. So Stephanie, thank you so much for your time today. We really appreciate it. And before we go, I do want to mention, though, from a standpoint of conversations, we had a conversation in our office here at the end of last year, and it was on brain health and cognitive decline. And as important as these conversations are around investments, there are a lot of families having very important conversations around other things that affect them on a daily basis. And so we started a series called The Time to Talk, and it'll help hopefully bring to the surface conversations that you will have with your family, with your friends, with your children, and their topics, everything from a standpoint of just money itself. And what does that mean to the family, and having conversations and, taking down the walls around healthy living, about memory loss, about, family meetings and communication around just the health of your finances moving forward. And in-home healthcare. These are all things that we're dealing with every day, and some of the companies even that Stephanie's looking at on a daily basis are hopefully affecting change there. We talked about AI, how does technology affect the family moving forward? So we urge you to speak to your advisors, one about your portfolio, your asset allocation, your financial plan, but also about these conversations. We feel like we can help facilitate some of those. They're important conversations. When we had that meeting here with the individuals that were here, I think it struck a chord. And so we look forward to helping in any way we can. So again, thank you everybody for joining. Stephanie, thank you so much for your time and your expertise. You've been an incredible partner, an incredible teammate. And we look forward to more of these conversations, and we'll check in again probably in about 6 months.
Sounds great. Thank you.
Thanks, everyone.